Greetings, listeners. I'm Bob Simpson, your host, and welcome to another episode of My Private Network podcast. Today, we are once again shining the light on private lending. Now, when we talk about private lending, we often use the mantra, be the bank. Why settle for meager savings rates when you can invest directly in companies and enjoy much higher returns? Our platform offers diversification through expertly managed loan portfolios, providing investors with opportunities typically reserved for the banks. But enough preamble. Today, we're thrilled to welcome a true expert in the private lending area, none other than Micheal Scott, Managing Director at SAF Group, joining us from his Vancouver office. SAF Group is a Calgary-based alternative capital provider. It offers institutional quality private credit strategies with a focus on direct lending, characterized by strong collateral and robust covenants. So today's discussion really fits into the category of investing for income. So hey, Mike, how you doing?
I'm well, thank you. How are you?
Yeah, thanks for joining us today. Now, I've been reading a little bit about your 10th anniversary Roots and Boots party that's taking place at the end of September, right? And I've been feeling like, hey, I can't make it. I think I'm going to miss out on the party of the year. But I think you've got lots of things to celebrate on at your 10th anniversary extravaganza there.
We do, yeah. Certainly 10 years is impressive. So we're looking forward to bringing together a lot of our clients and investors and stakeholders. And sorry to hear that you won't be able to join the party, Bob.
Yeah, well, sometimes you got to pick and choose and things come up and get in the way. So before we delve into the intricacies of private lending, let's just talk about your personal journey and that of SAF Group's and some of the things that you might be discussing at the 10th anniversary. And let's start with what drew you into getting involved in private lending in the first place?
Sure. Prior to joining SAF, I worked for two of the Canadian chartered banks, just over 20 years. Split my time at those banks between both corporate banking and leverage finance. And then, during my career, I also spent some time on the other side of the desk, as I call it, where instead of being a lender, I was on the borrower side, which in hindsight, as I pursued my lending career, certainly proved to be an invaluable experience. To answer your question, though, Bob, I think the short answer is that the Canadian banking landscape is really changing, and these changes are all centered around increasing and more burdensome regulatory capital requirements. I'm sure we'll dive into this in more detail today, but the short answer is these changes are making Canadian banks shift their business model away from lending, which is more capital intensive and generates interest revenue, to focus more on non-lending or non-capital intensive services or advisory activities, which generate fee-based revenue streams. I have always been a lender with my time at the Canadian banks, and certainly started to feel that pressure the last number of years. And as it was becoming more increasingly restrictive and burdensome, it was obvious to me that this regulatory shift was going to continue to accelerate versus something that was going to be temporary. So having known one of the co-founders of SAF Group, Ryan Dunfield, for 15 years, we had often talked about when the right time would be to launch a diversified private credit fund in Canada. And as I saw the regulatory headwinds for the Canadian banks growing, it just presented a great opportunity to join SAF's established private equity platform.
Yeah, no, that's cool. We all have experiences. The other day I was sitting in an office and I was waiting for a recommendation from a professional. And as I was sitting there, I thought, I need to ask this guy some questions because I have to make a decision. And I thought, what do I need to ask him? And I think we can look at today's talk through the same lens. I said, number one, what is it that you recommend? Number two, why are you recommending this to me? Number three, how am I going to benefit from this recommendation? What are the risks? Number four, and what will I experience over the next 2 to 3 years based on that recommendation? If I know the answer to those 5 things, it occurred to me, I can give you an answer. But if I don't know the answer to those 5 things, it's much more difficult. So if we sort of start there, we are big proponents of diversification. We understand the importance of spreading risk. That's why we collaborate with a wide array of private lenders and really trying to find diversification by style, diversification by many, many other things. If we start with the question, and we pretty much know the answer, it's private credit, but what are you recommending? In the seat that you're sitting in right now, what would you recommend to individual investors, and why would you look at that? But let's start with what would you recommend?
Look, it's a good question, Bob. I think, admittedly, I'm somewhat biased. But no, as we look at the traditional 60/40 portfolio, I think there's compelling, and it will go to some of your other questions around why and how you benefit and the risk profile. Certainly, we believe that there's a role for private credit in any prudent investor's portfolio.
Mm-hmm. Okay. So, number two, why would you recommend that to investors?
Yeah, look, this is an asset class with low correlation to other asset classes. It generates a very nice, stable, consistent cash yield, relatively low volatility. This is an investment where you're going to see your net asset value very stable from quarter to quarter or month to month, which we just think fits very nicely within a balanced portfolio.
Yep. And we agree with that. Now, as an investor, how is an investor who's looking to do something within the 60/40 and the fixed income part of their portfolio, how are they going to benefit versus traditional investments?
Yeah, look, and you'll probably hear this from me throughout our conversation, but look, we're building an all-weather asset class, so there's no concept of timing the market in private credit. We're investing in senior secured loans, very bank-like, risk-like profile, and these are going to perform in both challenging times and good times. So, often we say it's not a super exciting investment. This is an investment that can be quite boring, but we think boring is good.
Mm-hmm. Yep. And we look for boring in the fixed income part of the portfolio. You're taking much in the way of risk in other areas. So, if you're investing in a private credit fund, what are the risks? And we'll go into more of this in more detail in a few minutes.
Yeah, from a risk perspective, Bob, obviously capital preservation is really important to us. We invest at the top of the capital structure. So like any investment, this is not a risk-free investment, but I think your opening remarks was be the bank, and certainly we very much are the bank in the senior secured loans that we deploy. So if you really think about lending at that top, that first dollar in or the first dollar out, we're typically not extending past, call it 50% loan to value. So again, as we think about the macro climate will ebb and flow. The economy will be better or weaker at times. When you're investing at the top of the capital structure on a senior secured basis, you generally speaking have a significant lower risk profile than you would say in public equities.
Yeah, and we agree that loan to value, just explain, because not everybody who listens to this understands loan to value.
Yeah, so loan to value is when we think about, it's generally expressed as a percentage. We look at our loan. Say, for example, we're lending a borrower $1, and then we look at the value of our collateral. So generally speaking, if you are in that 50% loan to value range, for every dollar that we would be advancing to a borrower, we would have at least $2 of collateral, such that to the extent that there was a hiccup, or there was some variability in the value of that collateral over time, our capital would be preserved.
So Mike, now sort of, thanks for going through and answering those questions. I think that just up front gives everybody a pretty good idea of this. When we look at the private lending market versus the public market, what's the big difference?
Sure. I mean, private lending is just non-bank debt financing that doesn't trade in the public markets. So, if you really think about Canadian borrowers today, they really only have three options for borrowing. One is private lending, which we'll talk about today. The second is to go to a Canadian bank. And the third would be to access the public markets. With public markets, meaning like the issuance of bonds and other publicly traded instruments. So private lending is really just an alternative way for companies to borrow without going to one of the big Canadian banks or accessing the public markets. The challenge with public debt, though, is it's generally only available to very large corporate borrowers. And this is mainly due to minimum issuance size
Right.
requirements. So, often this can be in the hundreds of millions of dollars. So it's just that the public markets really are out of reach for a lot of Canadian companies. While on the other hand, private debt is a lot more accessible. I mean, depending on the fund, you can have, minimums as low as $1 million in the private lending space. So the range of companies that can access private lending is significantly broader than that of the companies that can access the public markets. I think the other component of private lending is that it often can be a lot more customized to a specific borrower's needs. The public markets can be quite rigid in terms of the types of structures that can be issued within that market, whereas the private lending market is a very customized, very bespoke, flexible market. So it's both issuance size and flexibility.
Yeah. So where would you say your sweet spot is on loan size?
Look, we're very much a mid-market Canadian lender. So, we will guide you to, loans in that 20 to $50 million range. We're and typically the lower threshold is really just a function of our diligence process, our underwriting process just really isn't conducive given its intensity to smaller loan sizes. But also as you go lower down on those loan sizes, you tend to start lending to smaller businesses, and ultimately your risk profile in a smaller business is just significantly higher.
Mm-hmm. So, Mike, what makes your firm different? The approach that you take to private lending, what makes you different than the other firms in this space?
Yeah, it's a very good question, Bob, and one I think we could answer in a number of different facets. But look, I think to keep it simple, it all comes down to the portfolio that we build for our investors, i.e., sourcing attractive opportunities where we can lend to established businesses, where our investors' capital is protected, and we can generate an attractive risk-adjusted return on that capital. So, how do we do that? We think there's three key ingredients. Number one, deal sourcing. So how we find investment opportunities. Number two, underwriting. So that's how we diligence, how we dig into opportunities before we actually advance a dollar, or we close an investment. And then number three, the monitoring and oversight of that loan post-closing. So, really, as you think about the first one, deal sourcing, at SAF, we have 7 partners, all of us with prior experience in banking, extensive networks across Canada, allows us to build a very large funnel of investment opportunities. This really allows us to be highly selective and focus on the most attractive risk return opportunities. But it also, because we see such a high level of deal flow, we have a very good sense of the market and where we're best served to invest our investors' capital. So that's how we source transactions, which we think is key.
I was going to say the funnel is really important, isn't it?
The funnel is incredibly important. Yeah, we always say like the bigger funnel that we can build allows us to cherry pick the best opportunities at the very top. And then once we pick those, underwriting, which is the second kind of key ingredient, is really the core part of our process. We have an incredibly deep team here at SAF. We have a very highly structured, very rigorous underwriting process. I would encourage you to go onto our website. You can see we have over 35 professionals. We have a deep team. We're truly indexed to professionals, and we do leverage the entire team as we screen and ultimately underwrite close new investments. We firmly believe this level of rigor is key to our underwriting process, but specifically around preservation of capital, as well as our ability to consistently generate attractive risk-adjusted returns. And then lastly, number 3 is on the monitoring and oversight. Because we have a very deep team, we're able to be incredibly hands-on with management. Everything we do is direct lending. So we have direct access to management teams, direct access to shareholders, the board, customers, et cetera, of the companies that we lend to. So we've been able to acquire extensive experience in managing various different challenging situations. The reality is not every investment goes in a straight line. There will be hiccups from time to time, and that's an important aspect to keep in mind. And it's incredibly important that we fully understand the business upon making an investment decision, and then we're tenacious on the monitoring and oversight post closing to ensure that any potential performance challenges are addressed. So, look, a lot there, but to summarize, it's how we build a portfolio, how we find deals, how we diligence and underwrite them, and then how we tightly manage those investments post-closing.
Right. And the depth of your team. That's the one thing that we're finding in the private lending area is you are getting new firms, but they don't, they don't have the depth of the portfolio. They don't have the experience when things go wrong. And that's really where you earn your money, isn't it? When things go a little bit sideways, that's a lot of work, isn't it?
The depth and the experience of the team is key. Again, not everything goes in a straight line. You're going to have hiccups. Being very proactive and being able to roll up your sleeves is key. And, we think that ability to be active or reactive, though, is also, if you have the right skills and experiences on your team, it is an avenue to significantly reduce, risk.
So we talked about the funnel and corporate borrowers that are coming in. Why are they choosing SAF Group instead of just going to the bank? And you explained the banks have less appetite for some of these loans right now, but do they favor the banks, or would the experience in working with a group like SAF Group be beneficial to the corporate borrower?
Yeah, it's a great question because I think investors often mistakenly assume that borrowers look to private debt solutions only in higher leverage or higher risk situations, which is not the case. I mean, certainly in the past, there's been more borrowers that would have fallen into that higher risk category, specifically within Canada's private credit landscape. Although, in the landscape today, there are more and more prime borrowers that are turning within Canada, that are turning to private lenders simply to get access to debt capital to support growth and expansion of their business. And it's a longer winded answer, Bob, but to try to simplify it, the key trend today in the Canadian landscape is a reduced appetite from the Canadian banks as they shift away from a focus on generating interest income towards a bias to service and fee income. And this is an entire topic in itself. We could spend hours talking through the nuance, and I'm sure we'll get into it a bit deeper here. But the punchline is that the Canadian banks are just starting to feel the impact of increased capital requirements, which is making capital more scarce and expensive for them. And as you make capital more scarce and more expensive, and recall when a bank makes a loan, they have to put capital against that loan. It impacts their profitability. So what we're seeing the banks do in reaction is, given the scarcity of capital, the cost of capital, they have to become a lot more efficient in terms of where they allocate that capital. And so they're allocating that capital in places where it's less capital intensive, and it's more profitable. And as a result, they're reducing their their appetite for borrowers that just want loans. If a borrower is only going to generate interest income, that's less attractive to them than a borrower that's going to generate interest income, but they're also going to be doing their FX hedging, their cash management, investment banking advisory fees, and they have all of the shareholders, personal wealth, etc. So, those kind of credit only borrowers, and those are those borrowers that we talk about in that $20 to $50 million segment, that core kind of Canadian mid-market company. There is the one that are impacted the most, that are looking to options, which brings them to us.
Right. One of the things I like to say is that financial services, especially the banks, they don't move quickly. But once you understand the trend that they're moving in, it's a pretty clear picture, and I look back that when did this shift to providing more of the services happen, and I worked at Nesbitt when we were taken over by the Bank of Montreal. That was 1986. So that trend has really been going on for quite a while. And I think they're seeing the profitability of doing some of that work. So I think, I agree with your thoughts there. How do you, as a firm, your job really in managing a fund is to generate returns for clients. How do you do that? What's a return profile look like for an individual investor?
Look, there's no magic formula. We generate returns almost identical to how the Canadian banks do. So if you think about, as we make loans to companies, we're charging a spread over the prime rate. We typically are charging, some form of upfront fee. We'll have some monitoring fees or a standby fee. All of these fees and interest flow through 100% to our investors.
Okay.
So it's, it's very much how the banks generate returns for their shareholders. I think it is important to note, though, that, some higher risk funds in the market will look for other return enhancements. So you will hear about, some lenders that will seek out equity warrants or other equity sweeteners that provide, augment returns. Generally speaking, they're compensating for increased risk. So as we think about, the kind of the risk profile of a borrower that we're looking for here at SAF, we're focused on those borrowers that are bank-like, have bank-like risk and have bank-like return profiles. So you won't find equity warrants and other sweeteners in our private credit funds. They are, straight, fees and interest, very bank-like, and generate returns very similar to the banks.
Yeah. So if you're doing, you talked about prime plus, we're now in an environment where we're starting to see rate decreases. How's that going to affect the marketplace for private lending?
Yeah, that's a very popular question. I would say we did see some impact here in Canada as we started to see the risk-free rate increase. I mean, the private credit market in Canada, although historically very different than what it is today in terms of composition and opportunity set, much more niche historically. But look, as it relates to rates, historically, the Canadian private credit market has been a fixed rate market. As we saw the rapid rise in the risk-free rate, the market has fully moved to a floating rate. I think that's also as you look at, the opportunity in Canada where, more and more bank-like borrowers are moving into private credit. They are just more accustomed to borrowing on a floating rate as as they've experienced with the Canadian banks. So look, all of the term sheets we issue today are floating rate. We've been successful in negotiating floors. So we do participate or have participated in the upside of the prime rate with downside rate protection. In terms of going forward, look, we don't have a crystal ball on rates. We do think that we're, in a declining rate environment. But look, our focus is on structuring to protect our downside in all aspects. Rate is one of them. We do that through floors. We're not trying to time the market, though. You're not going to see us flip back and forth on fixed and floating, trying to figure out and earn those kind of take risks to earn an extra
Mm-hmm.
25 bips. The reality is our loans are typically, call it 2 to 3 years in duration.
Mm-hmm.
And so pricing is being reset fairly frequently in any case.
Yep. So as we look at private credit market, um, what are your concerns in the market today?
Look, I think we're very much in a new era for private credit in Canada. Our private credit market is 15 years behind our global peers. It's all because of the regulatory burdens that Canada's been good at avoiding, but quite frankly, we have nowhere else to hide, and we've all heard about Basel III and Basel IV and other regulatory frameworks. Canada's private credit market is very quickly catching up to our global peers. So look, I think there's going to be some very attractive opportunities for investors going forward as our market here continues to expand and develop. What concerns me and us at SAF is, historically private credit in Canada, and I'm talking kind of 5+ years ago, had been a much more niche strategy, and one that isn't as deep as the opportunity set today. And so I think where we've seen funds falter in the past is raising too much capital, too quickly. And when you do this and that amount of capital you raise exceeds the opportunity set, and you're pressured to find a place to put this capital work, you introduce risk into the system. And we always say here, it's easy to deploy capital, it's a lot harder to get it back. And so the concern is when you have too much capital availability is that you go off
Yep.
you go off strategy, or you go higher up the risk curve
Mm-hmm.
to put those dollars to work, and that's when you can run into problems. So look, I think we're fortunate today, as we look at funds like our fund that's bank-like, they have much deeper opportunities to deploy capital. And so as we see more investor dollars flow into private credit, there's going to be a very stable home for those dollars at similar risk profiles. But suffice it to say, we're very, very focused here at SAF on not just having discipline around how we deploy capital, but also around capital raising. It's really important that we match capital raising with deployment to ensure that we stay on strategy. But it's not just the cadence of that capital raising, but it's how we raise, how much we raise, when we
Mm-hmm.
raise, who we raise it from. Ensuring that we have a very long-term perspective and a patient approach when investing that capital. And I think that's key to generating attractive risk-adjusted returns over the long term.
Yeah, and we've noticed that in some other firms when they've raised a bunch of money and then a few loans came due and they ended up with major cash drag in their portfolio. But you want to really be careful, I think, that how you deploy and that you're not going to have too much money. You got to go find a place, take more risk just because you got to do that. So, yeah, I appreciate your thoughts on that. Um, Sort of as we wrap up here, um, let's, the last of those 5 questions I threw at you at the beginning was, what should an investor expect what should the experience be like over the next 2 to 3 years? What kind of returns are reasonable there? Because, at the end of the day, an investor has to, and this is something I say all the time to investors, you should be trying to find the return that you need at the lowest possible risk that you can get, right? And a lot of investors with low interest rates have turned to equity markets and they've seen volatility and good returns, but they're not comfortable with that. But as we look over the short term 2 to 3 year horizon, where do you think? And a lot of it's based on where rates are and where they're going to go, and that's crystal ball stuff. But what do you see? What's reasonable for a longer term investor to expect in investing money with SAF Group?
Sure. Yeah. Look, I think, if you think about the gap that's being created by the banks as they're, pulling capital from the mid-market. I think that's really creating the opportunity set for investors today. And I think that's what really excites us here at SAF. But look, I think it's a very exciting time in the Canadian private credit landscape. We're continuing to see, the banks pull away. Again, our private credit market is 15 years behind our global peers. We're going to continue to see a scarcity of capital for mid-market borrowers. I think that's pushing a lot of Canadian companies into, the private credit space. And again, we're going to continue to generate above average risk-adjusted returns. Again, we're not chasing yield here. We're looking to preserve capital. You're going to see bank-like returns, but bank-like risk profile. Look, I think the key at the end of the day is, as we looked at other markets that have undergone this shift, again, that's the US, the UK, Australia, you name it. There's been this period of time as these regulatory constraints become implemented where there is a supply gap of capital. And so there is a period of time where you will see outperformance. We very much feel like we're in that space today. The Canadian banks have pulled back. Our private credit markets aren't as developed as they are in the US and elsewhere. It's going to take some time for firms like ours to come into the space. And so I think in the next, call it 18, 24, 36 months, potentially longer, it's going to be a very, very good opportunity as our market evolves here. It continues to develop and expand. There will be outsized returns for investors.
Yep. So a good place for people to allocate part of their portfolio is into the private credit markets over the next 2 to 3 years is kind of what you're saying. So
absolutely.
Yeah. So I feel good today. 3 good questions and 1 interesting question that that was your response to some of my questions there. So I appreciate that. That makes me feel good. Mike, just final thoughts looking forward, looking at this discussion, what are the key points that you would just like people to walk away and say, yeah, I think I learned something today?
Yeah, look, I think it's a very exciting time in the Canadian private credit landscape. There's going to be, and there is today, a very attractive opportunity for investors as our market continues to deepen and develop. The one thing that we remind investors, and you've heard me mention it today, is we're building an all-weather portfolio. We're not trying to time the market. And certainly as we think about the Canadian landscape and the opportunity set within Canada, there isn't because of this, regulatory burden and framework that's being adopted. We don't see this as a window. There's not a short period of time for Canadian investors to invest in this asset class. This is very much a permanent shift. This is an opening of private credit in Canada that's going to allow access to Canadian investors, bank-like risk profile, which they haven't seen in the private credit space in Canada historically. So investors are going to have the opportunity to invest in a more, bank-like risk profile. So again, senior secured loans at the top of the capital structure. They're going to be low correlation to other asset classes. Again, because we're at the top of that cap structure, you don't see a lot of volatility in your loan to value, and from a NAV perspective, all of our loans pay cash pay interest, so it generates a very nice, stable, consistent cash flow yield. So, look, I think at the end of the day, you're going to have an asset. An investment that's going to perform in both challenging times and good times. Again, this is a portfolio that is very actively managed by our team, and so we're very excited. We think that it's a very good opportunity over the next number of years to generate outsized returns as our private credit market here continues to develop.
Yeah, that's awesome. So, just in closing, Mike, thanks for joining us today. That was fun.
Thanks for having me, Bob. Appreciate the conversation.
Okay, before making any investment decisions, it's crucial to consult a professional financial advisor to determine suitability. Full disclaimers are available on privatedebtequity.ca. Now, please do not forget to follow us on your preferred podcast platform, subscribe to our YouTube channel to stay updated on new episodes. If you're eager to learn more about today's topic, just reach out. We're there all the time. Glad to answer any questions that you send our way. You can find our contact information on privatedebtequity.ca. So I am Bob Simpson. It's been my pleasure to guide you through this discussion today. Remember that knowledge empowers you to make well-informed investment decisions and progress towards your financial objectives. Until we meet again, just try to stay focused and disciplined on your financial journey. That's really important. So have a great day.